In addition to asset classes, some assets are classified into subcategories. Let's look at some examples of sub-asset classes within the main asset class of equities. In this example, we have 4 sub-asset classes: small caps, mid caps, large caps, and all caps. CAP is short for market capitalization. Market capitalization just means the total value of a company. So small caps are smaller companies. Mid caps are medium-sized companies. Large caps are the biggest companies on an exchange, and all caps would include all companies listed on the stock exchange. From our definition of asset class, we know that members of an asset class have similar characteristics, similar behavior or return patterns, and are usually regulated in a similar manner. You can think of sub-asset classes like narrowing down the risk and return characteristics a bit further. Small cap companies are often more volatile than large cap companies. They may also have the potential for slightly higher returns. Another type of sub-asset class example would be emerging markets equities versus developed markets equities. Stocks from emerging market countries may show higher risk and return potential than developed market countries, which in turn are more mature in their economic development. There are also sub-asset classes for fixed income. Some examples would be high-yield bonds. These pay a higher rate of interest, but that's because they carry more risk. Another differentiation is short-term bonds versus long-term bonds. Longer-term bonds are more sensitive to changes in interest rates than short-term bonds. You could also have government bonds versus corporate bonds. As you may have noticed, sub-asset classes are a way of further categorizing asset classes into smaller groups with a bit more precision in the general risk and return characteristics. You can even go further by combining some of these groupings further. You could be interested in long, corporate, high-yield bonds. These would be expected to generally be riskier than short government bonds, for example. Each of these major variables, stocks versus bonds, market capitalization, geography, yield, and more, gives us more granularity when constructing our portfolios, which can be helpful in managing risk through diversifying our holdings.